Big agenda this week. We'll start off with rates as we normally do. We'll look at nominal rates, real rates, and break-even rates. And I'm going to introduce you to the federal funds rate futures contract. And we'll look at that on the CME. We'll read the Fed minutes from May 4th, at least the important parts of the minutes. Have a look at the housing market, and we'll look at a REIT trade in Canadian apartment REITs. This trades on the Toronto Stock Exchange. Also look at a number of reports that came out last week. Durable goods report. We had our second look at Q1 2022 GDP. The big report on Friday, the PCE price index. And we'll look at the CBO, the Congressional Budget Office's economic projections, which came out this week as well. I'm going to introduce you to this particular formula, which is a way of looking at the value of the equity market by reducing it to two input variables and a multiple. U.S. CEO confidence survey, something important in here worth noting, something important here for our projection of where GDP would be going. We'll look at S&P 500 levels. There was an earnings revision for the forward 4 quarters, so we'll incorporate that into our multiples. Energy, we'll revisit our USO and UGA bull trades. They, by the way, worked out. And we'll look at our economic calendar for the week ahead. We've got a lot of stuff to cover this week, a lot of interesting information, and I think the narrative in the market is going to slowly shift over the next few weeks from one of stagflation to one of disinflation going forward with subdued growth. I don't think that the data at this point are suggesting a recession. But you never know what's going to happen in a month or in 2 months. All we can do is look at what we have, where we're standing, and look forward and say, well, do we see that kind of thing going on? And I'm seeing improvements in a lot of places that is going to improve the inflation situation. And really, in the end, if we didn't have an inflation problem, we wouldn't have a rates problem, we wouldn't have a market sell-off problem, we wouldn't have any of this. So let's look at what is going on in rates. Rather interesting. Right across the top, I got the 3-week change. Here is the rates as of Friday. And I've separated them into up to the 1 year here. These are money market rates. These are what are called capital market rates. Anything 2 years and longer is capital markets. A year and lower would be money market. Money market rates all up. Capital market rates all down. The 3-week change, that's rather large from the 2 year all the way out to the 30 year. These are 3 weeks in a row these rates have come down. So these are all lower. We can see here all lower on the week, and lower on the week with lower volatility. So two things happen over the past 3 weeks is rates have come down and the volatility in rates have come down with them as well. You have a steeper curve. And we have some curvature, although I don't know how long I'm going to keep putting this one up here because I can't really find much value to it. But there is a way to measure curvature, and maybe somebody finds curvature interesting. I find there to be no interest in it. Maybe at some point it'll be the thing to look at, but right now I think it's kind of useless information. We could just sort of do that on a go-forward basis, and I don't think we would lose any information at all. June 1st, keep your eye on June 1st, Wednesday, balance sheet runoff begins. You've got $1 billion a day in U.S. Treasuries on average. It might not be every day that there's $1 billion running off, but $30 billion will run off on U.S. Treasuries, and then anything above $30 billion will be reinvested. So I don't know whether they'll have a certain amount per day and then they'll reinvest over that amount per day to spread it out, or if it'll be from June 1st, and as soon as they hit 30 billion, okay, now we're going to reinvest. What if that happens in the first 10 days? That might dislocate the market and cause some volatility that doesn't need to be there. I don't know how they're going to do it, but on average, about $1 billion a day will run off the balance sheet. For mortgage-backed securities, on average, $580 million per day is going to run off the balance sheet. June 15th, it is fully expected that there's going to be a 50 basis point move even given the moderating inflation that we saw last week. The PCE came in nice. Well, I mean, it could have came in lower, but it's beginning to move in the right direction now for a couple of months. The year over years have been coming in the right direction, but I still see 50 basis points being the move at the next meeting. The Fed minutes suggest that 50 basis points is pretty much in there. And on the next screen, we're going to look at the Fed funds futures to see what the market is pricing in as the move all the way through to the end of the year. The Fed funds futures tell us what the markets bet on the probability or where the rate would be at certain months. We can go ahead and put 100% probability on this happening on June 15th. So June 1st, let's keep our eye on the yields, and let's see if there's any major dislocations. We don't really have to watch it. I can guarantee you Bloomberg will have their eyes all over this, and they'll have analysts on, and every little tick will be analyzed. Is this it? Was that a signal of it? What's going on here? But you really have to sort of step back and avoid the hour to hour, the tick to tick, the day to day, and really look at it week on week to see what the effect is. I had been asked by somebody to do these more frequently rather than do one hour and a half or 2 hour session on a Sunday. Why not break them up and after every major report, like when the Fed minutes came out, maybe put a video out that night that just talked about the minutes. I could do that, but I tend not to look at a lot of data or look too deeply at any data point while it happens. I wait until the weekend when markets are closed, and then I can put all the puzzle pieces on the table and I can look at them in totality, as opposed to looking at one puzzle piece at a time and then picking up another puzzle piece and looking at that one. It's hard to get a good picture of how everything fits together, or is there an underlying story going on all these pieces when you're looking at them all independently. But when you put them all on the table all at one time and you look at them, a picture starts to emerge. A pattern is there that you can move them around and say, well, this information fits with this and this information fits with that, and this looks consistent, so that you can see trends a little bit better, or movements in trends better if you look at it all at one time as opposed to piece by piece. Looking at it piece by piece, you might run the risk of changing your strategy for the week. And usually you'll get into trouble when you begin to change your strategy. When you begin to respond to every data point, you end up chasing the market around, as opposed to saying, look, I have a course of action. I think I'm right. From time to time, the market's going to be wrong. That's a bold statement, eh? The market's going to be wrong, and I'll be right. I think over last week with the data points that came out, it kind of supported the thesis that I've been putting forward over the last little while, that while a bear case exists, the bear case exists as a policy mistake. I don't think it is supported by the data, because for everything you can point out, I can refute it with other data points that are supportive. So, like I said last week, when you get a narrative that takes a hold like stagflation, when that narrative takes a hold, a lot of the data analysis goes out the window and you simply run with the narrative. But last week the data came home, and that narrative, had people scratching their heads saying, well, hang on a second, that doesn't fit my narrative anymore. I'm going to have to change my approach. Okay, real yields, all of them lower. This is extremely supportive for risky assets. When you get negative real yields, very supportive. This was last week. We had positive real yields from the 7 all the way up to the 30. Now the 7 has gone negative, and you have positive real yields from the 10 out to the 30, but you had big drops. Look at that. Down 16, down 14, down 12. Very supportive of risky assets. Break-even rates, all higher. Very odd. The capital market yields we saw on the last screen are all down. These are nominal yields. Money market yields are all up. This is supported by the Fed minutes and by the PCE. The Fed is saying, we're going to be moving 50 basis points at the next few meetings. I don't see why they would change their mind for June on that one PCE report. So that would tend to push money market yields higher. But the PCE inflation report showed a moderation in inflation, a continued moderation in inflation, and higher rates will moderate that going forward. So capital market yields pulling in kind of make a little bit of sense there as well. Real yields are lower. That is very supportive of risky assets, as I just said. Break-even rates higher. This is odd. If we are seeing the PCE moderate, we're seeing that the Fed is going to continue to raise rates, which will continue the moderation of inflation if we believe the interest rate can engineer the economy. You would have thought that these would have either been unchanged or even pulled back a little bit more. This is not consistent with the PCE price index or the minutes. So it simply could be that there is a market for tips and there is a market for treasury securities, and the participants in that market bid for what they want, and that we take the break-even rates as an artifact, and if we take them as an artifact, we have to assign less informational content to them. We just say, well, it's just a mathematical result of people in one market, the tips market, stating the price that they're comfortable with, and participants in the treasury market stating the price that they're comfortable with, and the difference between the two being the break-even rates might have nothing to do with what the participants feel comfortable with. They might not be considering what the break-even rate is. Oh, let's not bid that because the break-even rate would imply that it's higher and we think it's lower. So maybe there's just not the informational content in here that we would assume. But then again, it is only 1 week. So maybe the informational content and the break-even rates is meant to be looked at over a longer period of time as more of a running trend as opposed to week-to-week movements. But they've been fairly consistent in their informational content so far. But this week, got to put a big question mark there. All higher. I would have thought that they would have been either unchanged or slightly lower, but they are all higher. Let's look at Fed Funds Futures, 30-day Fed Funds Futures. The ticker, by the way, is ZQ. And if you want to watch the bond market, here are a bunch of other futures tickers. ZT is the 2-year, Z3N is the 3-year, ZF, F for 5 is the 5-year, T for 2, ZN for 10 is the 10-year. And then there's a TN. I think this is a better one to watch. It's the Ultra 10-year. The underlying that can be delivered for this is anywhere from a 6.5, I think, to a 10-year treasury, whereas this is a 9.5 to a 10-year treasury that must be delivered as the underlying to the futures contract. So it's closer to what a 10-year would be. TWEs for the 20-year, or you could just watch TLT if you're looking at it from an equity point of view. It's not going to give you much in terms of what the price of the bond is, or what the generic bond is, but it's just the direction of the ETF. And then there's ZB, the big guy for the 30-year. It was under 140 for a while. It's back above 140. So let's look at our the Fed Funds, 30-day Fed Funds futures. They're quoted like this. And we see this 99.235. And it's index-based, which means it's 100 minus the federal funds rate as of the date of expiration, what the market believes the federal funds rate will be as of the date of expiration. So all we have to do to recover what the market believes the federal funds rate is take the difference between 100 and where the index is. So for here, for May, we have 0.765, and the federal funds rate is 70, let me get rid of that, 75 basis points to 100 basis points right now. June 1.08, and you could see it increasing. July 1.4, 1.8, 1.9, all the way to December 2.5, 2.535%. So we can assume a range 2.5% to 2.75% in there, and then increasing 2.81 or 2.75 to 3%. For December 2023, 97.19. It keeps going, but there aren't very many prices beyond December 23 because there's no liquidity in them. You have a lot of liquidity in the front months. I'll show you the site where I got these from. And from there, you can get a whole bunch of rates. If you're interested in swap rates out to 10 years, swap rates are based on the secured overnight funding rate. They used to be LIBOR based, but now they're secured overnight funding rates. They've gone from unsecured interbank rates to secured rates, so they will be lower than what LIBOR would be because they are secured rates, so they can be seen as a risk-free rate in that sense. They're used for swaps and primarily the pricing of derivatives, all derivatives. When we price out a forward price or pricing out not interest rate, but options or futures forwards, and whenever we have to calculate the cost of carry, there's an interest rate involved. It's going to be these rates and not treasury rates. So let's have a look at that because it's a neat little site if you're looking for rates. If you're looking for the term structure of different types of rates other than just treasury rates, there's a whole bunch there for you. And then we will look at the minutes. We'll spend some time with the minutes because we want to understand when the Fed is meeting, what do they look at? What are they talking about? And we'll see some of the things that they're talking about and some of the things that matter to them. And they are looking at a lot of the stuff that we look at. So it's not as if there's some secret stuff going in the room and there's some information that they have access to that we don't have access to. They have access to the same information. It's, well, what are they talking about? What's important to them? Because if we know what's important to them, that's stuff that we can pay attention to as well. Okay, so here we are. This link is in the description box below, 30-day federal funds, and if you scroll down, you have them all listed under here, all the way down to, you can load more. It goes to December of 2023, and then after that, they sort of just disappear. Some of them have no quotes at all because there was no liquidity in them at all. This one here had a volume of 11, so there just wasn't enough to get any kind of price in there, but you can see how liquid they are at the front end. For May here, 1,600. Then you jump to 18,000. The active contract is June, 18,000. 33,000 in July, 31. So with this kind of volume, we can get some good market pricing in there. Up here in the top corner, view an interest rate product. Just click down on this and you have a whole bunch of different ones that you can look at. There is the secured overnight funding rate, 1 month, 3 month. And you have your U.S. Treasury rates, but we can get those right from treasury.gov. This gives you, as it's moving throughout the day, this will give you some intraday movements as well. Swap futures. So you have swap rates all the way out to 7, 10, 20, 30 year, and it just keeps going. There's a whole bunch of interesting rates here, depending on what it is that you want to get done or what you're looking for. There's some interesting stuff here. Okay, the minutes of the FOMC meeting from May 3rd, May 4th. This was released Wednesday at 2 p.m. The link is in the description box. If you want to hit pause and go get the link and follow along with your own PDF, that's fine. I've highlighted some paragraphs on here that I think are important. Other ones I didn't highlight, not because I don't think they're important. It's just I'm not going to read the whole 12-page report to you. You can read it, but ones paragraphs that I thought were worth reading. Developments in financial markets and open market operations. For the current meeting, federal funds futures implied around 50 basis points of policy rate tightening. So they are looking at it. They're saying, look, the market expects 50 basis points. It's priced into the Fed funds futures from market participants. We wouldn't be shocking them if we gave them 50. It's priced in. The median desk survey respondents also projected 50 basis point increase in the target range at the two following meetings. And another 125 basis points of increases by the middle of next year. So not only 50 at this meeting, but they're expecting another 100 points here, 250 in the next two, followed by another 125, 225 on top of the 100 basis points, so 3.25. bringing the projected midpoint of the target range to a peak of 3.13. The target it's a range of 25 basis points, so it's 3.25. It's 3 to 3.25. The midpoint 3.125, but they went to 3.13. Substantially higher than in previous surveys. It'll be interesting on a going forward basis if that is moderated. We got to think back to this period of time, back at May. We can't. We have to sort of just ignore the last week that happened. Most market participants anticipated maximum redemption caps of $60 billion per month for Treasury securities, $35 billion per month for agency mortgage-backed securities, with the caps phased in over roughly 3 months. Well, this is exactly what they said at their last meeting. So what they're saying is that, hey, the market expects us to do exactly what we said we would do. So these sort of 3 paragraphs give them the green light for 50 and the begin balance sheet runoff, because it is not surprising the market. They're noting that it was well telegraphed and that the market is expecting it, that it's priced in, and there are probably no dislocations by doing what's exactly expected of them. Financial conditions tightened noticeably over the period. What do they look at when they talk about financial conditions? Treasury yields, private borrowing rates, 30-year fixed rate mortgage, equity indexes. I'm highlighting just this. I'm not going to read it, just in case you're wondering, when they talk about financial conditions, what do they look at? Well, they're looking at treasury yields. Treasury yield increased across the curve. Long-term private borrowing rates moved higher. 30-year fixed rate mortgage above 5%. Equity index ended the period substantially lower on net. The dollar appreciated. So they're looking at the things that we can easily look at as well. Market and survey-based measures of U.S. inflation expectations continued to project significant deceleration in inflation in the coming years. Pay attention to the language here. Not just deceleration, project a significant deceleration in inflation. This is what they're talking about. Market participants remained attentive to the risk that in bringing inflation back to 2%, the committee would need to tighten by more than currently expected. What else do we have? Nothing here. U.S. real gross domestic product declined in the first quarter. When it came out, the video we did broke it down into the C, the I, the G, and the X minus M, and we saw that C and I were quite healthy. First quarter growth in private domestic final demand was faster than in the previous quarter. So they do note that, it declined, but the C component, the consumer component, was very healthy. Both the PCE and residential investment increased in the first quarter at rates similar to those seen in the fourth quarter of 2021. Business fixed investment growth picked up sharply in the first quarter. We noted that as well, with spending on equipment and intellectual property products posting a large increase. Let's keep going. What do we got? Anything in this column? Nope. Over the intermeeting period, along with the increase in treasury yields, borrowing costs increased in many sectors and were at or somewhat above pre-pandemic levels. Credit remained widely available, and borrower credit quality continued to be strong overall. That does not sound like an economy. At that time, beginning of May, even now, this is still true. That does not sound like an economy that we would say, aha, recession. Maybe you can predict out 9 months or a year saying, it seems like we're going to hit a recession, but none of the data are supporting that as of yet. Credit, which remained widely available for most types of borrowers, was broadly in line with pre-pandemic levels. Commercial and industrial loans and commercial real estate loans on bank balance sheets also grew robustly in March. Wow, banks don't seem too concerned, right? A continued easing of lending terms and strengthening demand for C&I, that's the commercial industrial loans, as well as easing standards for multifamily CRE loans. They reported a continued easing of lending terms and a strengthening of demand. Rates were elevated. They noted earlier in this report that mortgage rates were over 5%, and borrowing rates are elevated, and loans on bank balance sheets grew robustly in March. Continued easing of lending terms, strengthening demand. Again, that doesn't seem like the interest rate is doing very much to engineer the economy. And I've said this last week that I think that we give way, way, way too much credit to that short-term rate to engineer the economy. I don't know that it affects a lot of behavior, especially consumer behavior, because consumers will always make the lifestyle choice first. They make the financing decision second. Let's keep going here. In consumer credit markets, consumer credit now, this up here was commercial and industrial and commercial real estate. Now we're talking about consumer credit. Credit card balances grew strongly in the first quarter amid easing standards and greater utilization, and auto credit outstanding continued to grow steadily through February despite vehicle production shortfalls and low vehicle inventories. Residential mortgage credit conditions remained accommodative through March despite the increase in mortgage interest rates, particularly for stronger borrowers who met standard loan criteria. The credit quality of firms, municipalities, and households remained strong overall. The volume of credit rating upgrades for corporate bonds, this is important here, volume of credit rating upgrades for corporate bonds outpaced downgrades moderately in March, continuing a nearly year-long pattern. The credit quality of C&I, again, you're saying, what's C&I? We saw it back here, right? Commercial and industrial. The credit quality of C&I loans on banks' books continued to be strong as delinquency and default rates both remained low. Delinquency rates on bank and non-bank loans to small businesses edged down in February, while in the CRE sector, commercial real estate, borrower financial health continued to recover. Household credit quality remained strong. Delinquency rates across both prime and non-prime borrowers continued to be subdued by historical standards. Why so much time on credit? A credit problem is a big problem. So you don't want to have a growing credit problem, because when credit stops, all sorts of things stop. And then you pretty much are going to have a recession, and they tend to be nasty recessions when they're credit led. This is not showing any issue with credit. In past updates, I have noted that recessions do not necessarily mean a contraction in credit. That we've looked at a number of recessions, and if the recession was not credit induced, credit actually grew through the recession. Consumer credit actually grew through the recession. So if we are going to get a recession, it's not going to be credit induced, because it seems that these are healthy numbers. These are not warning signs. It's not as if they're going the other way. It's not, oh, this worsened a bit, delinquencies rose a bit. Credit quality is, we have more in delinquency. It's not saying that at all. A lot to read on this page, because there's just a lot of good stuff. The staff noted that increased uncertainty and ongoing volatility had reduced risk appetite in financial markets and eased price pressures, although valuations of many assets remained elevated. That caught my eye. Valuations of many assets remained elevated. What assets, I thought to myself, what assets are you talking about? But we don't get too much into them. CRE, commercial real estate valuations, appeared somewhat elevated, except for sectors that were affected most by the pandemic. Residential house prices had risen rapidly, although the staff continued to see key differences from the previous debt-fueled housing boom. The mortgage finance reforms enacted in 2008 limited the potential for significant deterioration in underwriting standards. Most new mortgage debt had been added by borrowers with prime credit scores, and homeowners' equity positions were healthy. So they're saying what you're seeing now in housing, that is not 2008, and it's not. 2008, there were houses aplenty. There was overbuilding and very lax credit standards. If you could breathe, you got a mortgage. Well, right now, we don't have overbuilding. We have underbuilding. We have a lack of supply. We have rapid turnover whenever there is supply, and that is supporting higher house prices. And the borrowers, the mortgage holders, are meeting higher standards. Households' debt to GDP ratio remained relatively low, and there were few signs of increased stress among lower income households. Business debt remained elevated relative to its pre-pandemic history, but interest coverage ratios were high. Lots of time on credit. Staff economic outlook. The staff noted that the first quarter decline in real GDP was driven by categories of spending that had often been volatile in the past, and they viewed the continued strength in private domestic final demand, the labor market, and industrial production as providing a more accurate picture of the economy's direction in the first quarter. When we presented the numbers for first quarter GDP, it's the same conclusion that we arrived at. It's like, okay, you have a pullback in government spending, primarily in defense. Okay, well, that's going to hurt GDP, but that's good. That's good. Fewer taxpayer dollars going towards that. And you had a whole bunch of imports that landed in the first quarter. The bottlenecks at ports cleared up and all that inventory came in and dragged GDP negative. But if we just look at the consumer and business investment, we had positive GDP. Staff therefore anticipated that GDP growth would rebound in the second quarter and advance at a solid pace over the remainder of the year. I'm going to show you a high-level view of how we value equity markets, or a nice, easy way to value equity markets that give you a direction. They're not going to give you a price target, but they give you a good idea of the direction by looking at two variables. One of them is GDP growth. So remember this line. GDP growth would rebound in the second quarter and advance at a solid pace over the remainder of the year. GDP growth was then expected to slow in 2023 and 2024 as monetary policy became less accommodative and financial conditions tightened further. When they say financial conditions, what do they mean? Go back up here. When they talked about, where did they talk about financial conditions here? Let me find it. There it is. Treasury yields, private borrowing rates, 30-year fixed mortgage, equity indexes, the dollar itself. Any of those things that would be going in the opposite direction from what they note would be a tightening, loosening of financial conditions, including the market going up. Expect to be in line with potential. Where did we leave off here? GDP growth is expected to slow and financial conditions tighten. By 2024, real GDP growth was expected to be in line with potential output growth. The staff's projection for PCE price inflation was revised up slightly in the second half of 2022 and 2023 in response to the slow resolution of supply constraints seen over the first part of 2022. This is May. Over the month of May, quite a bit of supply constraints have loosened up. If we look at the Freightos container index, it dropped 7% in a week. I showed it to you last week. I showed the price when we talked about Walmart and Target, talking about container pricing being up. Since last week, just this past week, it dropped 7%. The Port of Los Angeles is reporting the fewest number for the year, the fewest number of ships waiting to come in. Under 30 or something like that, down from like 80 or 90, under 30. And the shipping companies are reporting the highest amount of availability in ships for leasing ships, the highest amount of availability since the beginning of the year. So we're seeing it happen in transportation. So slow resolution of supply constraints, those resolutions are coming in. A higher projected path for import prices and a judgment that wage increases would put more upward pressure on services prices than previously assumed. You know my opinion on this. I have no problem with wage increases. Wage increases create a healthy economy because most of these people, 70% of wage earners, 70% spend every penny they make. Their marginal propensity to consume is 1. Give them more money, they will spend more of it, which creates a healthy economy. And if we truly are concerned about income and wealth inequality, the best mechanism to resolve that is through wages, not taxes. The best mechanism is through wages. So this does not bother me at all. If we have to live with inflation for a while because it is wage driven, I think that's only a good thing. All told, total PCE price inflation was expected to be 4.3% in 2022. That would be headline. We, I think, saw 6.3 on the REIT on Friday. Expect to be 4.3. PCE price inflation was expected to step down to 2.5% in 2023 and to 2.1% in 2024. as supply-demand imbalances in the economy were reduced by slowing aggregate demand and an anticipated easing of supply constraints. Well, you're not really slowing aggregate demand that much. The month of May, in terms of consumer purchases that are being preliminarily reported, were strong. So I don't know that the interest rate is having much of an effect in slowing down the consumer. However, supply is easing on its own. A lot more companies are reporting that the wait time isn't as bad as it used to be. It's getting better, but they still exist in certain areas. Housing still has a problem. Automotive still has a problem, and we'll look at housing in a little bit. We're almost done here. We just got a little bit more to read. An easing of supply bottlenecks, a further rise in labor force participation, and the waning effects of pandemic-related fiscal policy support were cited as additional factors that could help reduce the supply-demand imbalances of the economy and lower inflation over the medium term. A couple of participants reported that their business contacts continued to see robust housing demand and elevated home prices despite higher mortgage interest rates. Doesn't sound like interest rates are having much an effect. We're going to dive into this a little bit more when we get through this. The ability of firms to meet demand continued to be limited by labor shortages and supply chain bottlenecks. Yes, what I've been saying for quite some time. Although some participants noted that their business contacts had reported an easing of supply constraints, participants assessed that supply constraints overall were still significant and will likely take some time to be resolved. Keep in mind, this was back in May. It is going to be interesting to read the minutes for June. We won't see June till the second week of July, but it would be interesting at that point to remember where we were today, and it'll reflect the month of May. But they're already seeing, as of May 3rd, they're already seeing some easing. A few participants indicated that some of their business contacts were reportedly hesitant to expand capacity or had postponed construction projects. This is an important statement, and we're going to have a look at the survey of CEOs, or the CEO survey that is put out. I think it's by the Census Bureau, and that was released last week as well. And it's important to look at what their expectations are for capital spending, because that is the I in C plus I plus G plus X minus M. That is the I. And if you think that, look, my cost of capital is going to go up, you guys are actively trying to destroy demand. Input materials are the most expensive they've been right now. Any investment I make will be at the most expensive price. Maybe I'll wait. Maybe I'll just wait a year before I make these investments. It's these types of investments that enhance productivity. When you add more capital or you buy capital that is more productive than the capital you used to have, you can make the same quantity of goods with the same amount of people but cheaper. Or you can make more goods for the same price. That's productivity, and that's how you overcome these wage gains. So you got to give your staff 5, 6, 7% wage increases year after year to keep up with inflation. You need productivity. They're holding back. That's going to be an issue for corporate margins, and it's also going to be an issue for GDP growth, because it is the I in GDP. So we'll see what CEOs say about this, but that was notable when I read that they were reporting that they were hesitant to expand capacity or had postponed construction projects. Business contacts continue to report difficulties in hiring and retaining workers. Yes, I can tell you that is a real thing. A few participants noted that there were signs that the pandemic-related factors that had held back labor supply might be abating further, especially in the case of prime-age workers. And we did dive into the participation rate by age cohort, and we noted that prime-age workers were lower, like some 3% lower than they were pre-pandemic. A few other participants suggested that the unwelcome erosion of real incomes due to high inflation may have contributed to the increase in labor supply. And I did note, I don't know how many updates ago, but I did say that one way that the participation rate would increase is if the cost of living began to increase for households, then somebody who was out of the workforce would say, well, I can always get a part-time job to make ends meet, or I can go back to work to make ends meet. And that's what they're seeing as well. Many participants indicated that they expected the labor market to remain tight and wage pressure to stay elevated for some time. Honestly, I don't see that as a bad thing. Here's the danger. If we have a labor problem in America, and Canada has the same issue, if we have a labor problem, you basically have a population problem. And this is a growing theme for a lot of analysts around the world, saying, look, the world has a population problem. Population growth is slowing. You may think, but that's a good thing. Not if you always are after continual economic growth. Then population slowing down means at some point you're going to have to live with GDP growth flatlining or even going negative. So I think that at some point in the future, we will have to move away from GDP at a country level and looking at GDP per capita growth and measuring growth in GDP per capita. Even though aggregate GDP may be lower, if we can continually have GDP per capita increase, well, you can have a shrinking population that's still doing better and better. The problem with this statement is this. If this remains a problem for too long, companies will outsource the problem. They will outsource it to countries that have an abundance of labor, and there'll be less here in terms of productive jobs here because, well, if we don't have the people here, companies aren't going to say, well, let's just make less. They're going to just send those jobs to where the labor force happens to be, which will affect imports because now you're going to have to import that stuff. You've outsourced that work somewhere else. You're going to have to import whatever that final amount is, while imports lower GDP growth. So hopefully this can be, the combination of holding back on expanding capacity or construction and productivity enhancing investment, along with a lengthened period of time where the labor market is tight, is going to eat at company margins for a while. So, those two little points are interesting. Let's see what else we have. Participants agreed that the committee should expeditiously move the stance of monetary policy towards a neutral posture through both increases in the target range for the federal funds rate and reductions in the size of the Federal Reserve's balance sheet. Well, we know that, right? Expeditiously move, not move towards a neutral, so expeditiously. That implies a lot of front-end loading on big rate increases. Most participants judge that 50 basis point increases in the target range would likely be appropriate at the next couple of meetings. So they're going to move 50 basis points at this one, and they all agree, well, most, not all, most agreed that 50 basis points in the target range would be appropriate at the next couple. So June, I think 50 basis points is in. And then the next one, I believe, end of July, beginning of August, end of July, I think, another 50 basis points. A number of participants remarked that after balance sheet runoff was well underway, this is important here, was well underway, it would be appropriate for the committee to consider sales of agency MBS to enable suitable progress towards a longer run, so you could just call that balance sheet, portfolio composed primarily of Treasury securities. This is critical. Any program of sales of agency MBS would be announced well in advance. Mortgage REITs have taken a hit because of this, thinking, oh, the Fed is going to start selling. That's going to lower the price of the very assets that we hold. Then they're saying, yeah, possibly, but we will tell you well in advance when we're going to do it. And since they haven't said anything yet, they have no plans to do it anytime in the next 12 months. When they say they're going to tell us well in advance, it's when they tell us that they're going to do it that we can start thinking 6 to 12 months out they are actually going to start to do it. So I've said this before, I think mortgage REITs have been sold off too hard. Many of them are down significantly. And during the week, I noted on Bloomberg that a Goldman Sachs analyst came out and said the same thing, that she believes that mortgage REITs, because of this statement, that mortgage REITs are overdone. And so she suggests buying mortgage REITs over the next while. Participants judged that it was important to move expeditiously towards a more neutral monetary policy stance. They also noted that a restrictive stance of policy may well become appropriate depending on the evolving economic outlook and the risks to this outlook. I'm not sure that we're going to get to a restrictive stance. I think they'll move towards a neutral stance. Don't know that they'll get to that full neutral stance. I think the next two meetings of 50 basis points are probably in there. And then I think the data will start suggesting that inflation really isn't what you thought it was, that it's not as bad as you think it is, that it is coming down because supply constraints are opening up. And it's not a question of constrained capacity. It's a question of just constrained supply at this time. Well, I guess that's the same thing. If you have constrained supply, you have constrained capacity. I guess what I'm trying to say is it's not an issue of we're bumping up against the limits of the capacity that we currently have. There's spare capacity. There's just no one to show up to work, or there are just some cities that are just completely shut down. And I think we're done. Yeah, the rest is just a listing of what they actually did that day, and we all already knew that. But this gave us some good insight into what they're thinking and where they're going. Okay, housing. Nice snapshot. I tried to put as much as I could on one screen, and then we'll talk about our home builders down here. 30-year fixed mortgage rate 5.25%. It was over 5% at the May 3rd meeting, and they noted when we read the minutes, they noted that demand for mortgages still remained robust, that the borrowers were of a higher credit quality and prices remained elevated. We got this report, new home sales for April this last week, 591,000. This is on a seasonally adjusted annual rate. So you look at the home sales in April, you'll seasonally adjust it, and then you'll annualize it. So if April were indicative of the whole year, we would expect a little under 600,000 houses to sell that year, which is low. This is a drop of 16.6% month over month. It's 27% lower year over year. You would think, aha, higher interest rates are doing the job. Inventory sitting at 444,000. It's doing the job. This is housing inventory, active listing count in the U.S. Look where we are, way down here. This is 2017, 2018, 2019, and then straight down. That's active listing counts, 409,000. Housing, this is median days on the market. Look where we are. These low points are either a May or a June period. That's the best time for house sales. That's where everybody's in the market. May and June, the spring season, they get out there. These are typically Januaries. These peaks over here are Januaries, because after you get past the summer and you start getting into the fall, well, the kids are going back to school, and do we really want to move ahead of Christmas time? And by the time New Year's comes around, January passes, they start making plans to sell in the spring. Look where we are in terms of how fast these houses are moving. Never have they moved faster, going back, all the way back to January 2017 here. This is January 2017, so this is sometime in 2016. There it is right there, July 2017. Straight down. So you have a situation where you have almost no inventory. Houses are going super fast. We can start to put these numbers in context. Sales are down at this percentage rate because year over year there just isn't anything to buy, and whatever is out there gets snapped up really fast. An interpretation of rising rates would look like this. Inventory was, let's say inventory was here, and inventory did this, and days on the market did this. So it's staying on the market a lot longer. Inventory rates are rising, and you have these numbers. You can only come to one conclusion. Demand is being destroyed. Demand's not being destroyed here. Not at all. Mortgage applications, May 20th, refinancing's down 3.9. Not surprising. Why would you refinance at a higher rate? That's perfectly in line with rising rates. Is you got a lower rate, bonus, just sit on it. Purchase index up 0.2%. Last week it had a big plunge, but 0.2%. Kind of back up again. Let's look at our home builders. We have Lennar, D.H. Horton, and Pulte Homes down 27%, down 29%, only down 18% here. This is their dividend yield, 1.85, 1.2, 1.3. They do have options, but they're not friendly options. I mean, they're there, but you on some of them you have like 30-cent spreads, you know, where it's $2.70 bid, $3 offer. I mean, you can go in the middle of the spread at $2.85. You might get filled, but these are the kind of options where, you know, I call them Hotel California options. You know, you can get in, but you're not getting out unless you cross that spread. So, you know, you can check in anytime you want, but you're not leaving. So it's, you know, when you use the options on these companies, one of them, I think it's Pulte, has a tighter spreads than the others, or was it Lennar, DH? I forget. One of them, you'd have to look at them. One of them has tighter spreads than the others. Well, what do we make of this? That's a significant enough pullback. But the home builders are in the same problem as the auto manufacturers are. Ford and GM don't have a problem with their margins. They have great margins. Tesla, great margins. They have a revenue problem. They don't have a demand problem either. They sell every car they make. They just can't make enough cars. It's the same with the home builders. They deliver every home they build. They can deliver it. Last week we talked about a company that was delivering homes without windows, just boarded up windows, saying, we can't get windows. It'll be 6 months, but there's no point in waiting. Go ahead and move in, and as soon as the windows are in, we'll come by and install your windows. Whatever windows are missing, we'll come and install your windows. And people are moving into their homes. So if you have a revenue problem, well, your earnings can only go so high. You have an earnings problem. You can't get earnings growth unless you get revenue growth. Labor supply, material supply. There's a shortage, especially windows. Windows are a big problem. And I've already told you my story about windows. Windows still are a big problem. The friend I have who's building behind on the road behind me, he built 2 units. One of them is already up for sale. It's not finished. And it won't be finished for some time because parts for house, but the supply of materials. Can't get certain things, but is just looking at the market right now saying, I know mortgage rates are going up. The market might be softening. It's springtime. Let's sell it now for maybe an end of summer closing. It's not done. So there's not much. It's not like you're doing a walkthrough of the house. It really is not done at all. You know, the brickwork is not done. It's a wooden structure with you know, that you can walk right into and look around, and it's all framed. So maybe, you know, there's a benefit there saying, well, can we wire it up a different way? But that's up for sale now, and it's not done. So it's not time to buy the home builders. Not until this problem ends. Not until you can actually build more homes. Not until you can actually solve the labor supply and the material shortage supply. Not until you do that, you have a revenue problem. Much like GM and Ford right now have a revenue problem. They can sell every car they make. They just can't make enough cars. Take Toyota, for example. They were projected to make 950,000 cars per month. They lowered that to 850,000, not because of demand, but because they said the parts we need, especially the semiconductors, simply aren't available. So they cut production by 100,000 units a month. Well, that's got to affect earnings, right? So if you don't have earnings growth, Even if you apply the same multiple to them, say, okay, well, 10 times PE. Well, if your if your E is not going up, your P is not going up. And this is the problem with home builders right now is I think they're down until their supply constraints repair, which I don't know how long that's going to be, but if you're into the home builders, you really got to watch, watch that for them. If you're already in these, yes, the options aren't very friendly, but they do exist. You can put an offer in the middle of the spread to see if you get them. I would be selling calls. I would be selling calls because I don't see a lot of upside to the home builders at this point in time. I wouldn't run away from them. If you're in them, I wouldn't. I don't know that I would dump them. If you can generate a better dividend using the options, I would do that. Go out every 3 months, see what you can grab on the upside, sell some calls, and just enhance your dividend for a while. Use the income from the calls and the income from the dividends to keep adding some shares, because that's just as good. I mean, coming out of this, instead of having 200 shares, you now have 270 shares because you worked the options and you reinvested. Well, then you have better upside coming out of it. And this will fix itself. It will repair itself. I just don't know when. I wouldn't be buying home builders at this point in time because they have a revenue problem. And that's the problem I have with GM. GM is one of my biggest holdings right now. And let me tell you, that is my biggest mistake that I've ever made, is not getting out of it sooner. But I do work the options. I work the options so that I am, as each month goes by, working my way out of that hole. If you have access to the options course that I have, I show you how to work your way out of a hole, by the way. I did a trade intentionally to get into trouble. Sold puts on ChargePoint, CHPT. Sold $18 puts and $17 puts on ChargePoint early in the year, not knowing, but having a very high conviction that I was going to get in trouble, that those were going to be put to me and I was going to lose money on them. So I allowed it to be put to me, and then I slowly worked my way out. And it took, I think they were assigned to me in January, on the January assignment. And by April, I was out of them with a $4,400 profit. And I think I had sold 10 of these and sold 10 of these. So I had 2,000 of the underlying. And then just worked the options over the next 90 days and got out with a $4,400 profit. So that's sort of what I'm doing here. And that's what I'm suggesting you do if you are already in these names. Going from negative $4,000 on a stock to zero is the same as selling this one, buying another one at zero and holding it to a $4,000 gain. It's the same gain. You're already in this. It has a dividend. You can sell the calls. Again, not the best calls out there, but perhaps you can find a nice ETF that has more liquid options where these are within that ETF, and you could just sell calls on the ETF itself, because the ETF is not going up unless the three biggest ones go up. Plain and simple. Okay. So all is not lost in the real estate space, by the way. Maybe the home builders just aren't ready, but because it's lack of supply, Apartment REITs are fantastic, and they've been unjustly punished. Do you think that tenants in apartment buildings are saying housing prices are going up, houses are harder to find, and interest rates are going up? Oh, I'm moving out. No, they're not going anywhere. And if anything, the rents are going up. So apartment REITs, being that they've been beaten up unjustly, I find to be very attractive right now. They're not a sexy thing to invest in. It's not one of the big high-flying names that you think, wow, this will triple and go up 300, 400%. It's not a Tesla or an Apple, but these are nice earners, and they're a nice, safe place to be. Well, they should be a safe place to be. You wouldn't know it from year-to-date performance, though, but when something pulls back enough, you have to look at it and say, the market's wrong. And by the way, the market is wrong a lot of times. The crowd, when the crowd goes to extremes, it's always wrong. This is Canadian Apartment REIT, CAR.UN on the TSE, a 6-month chart. we can see that it had at the beginning of the year. This is end of December, and then the first couple of days of the year, and then all that talk about inflation and rates started, and it sent it all the way down to $46, and we were up around almost $60 at one point, over $60. Funds from operations per share, FFO per share, 226, dividend of 140 a year. That is extremely manageable with a lot of money left over for reinvestment. Book value per share 59.60, and we're at 48.87. It had earnings about 2 weeks ago, and earnings were good. They were really good. And then you can see here 10 days ago, 11 days ago, the analysts that follow it came out, and usually after earnings are reported, analysts then come out either reaffirming their guidance or changing their guidance. RBC Capitals, TD Securities, Raymond James, Echelon, I'm not sure how you say that, Wealth Partners. Buy. Look at their targets, 66 on both RBC and TD. Was it 66 here again? Raymond James, 62.50 here. Maintained their rating, their buy rating. 5 buys, 1 hold, average price target 64.10, rated as a strong buy. I agree. I agree. June 1st, we have a Bank of Canada rate decision. 50 basis points is expected. So if I've already owned shares of this one, quite a few, and I don't mind buying more. The options aren't as liquid as I would like, but they are doable. They've got about a 15-cent spread between the bid and the ask, but they're doable in 3-month periods. I wouldn't go out 1 month at a time and sell them, but at 3-month periods I would. So the July call is roughly 40 cents now. I sold them when they were 45 because I was buying when it was doing this. I was saying, this is ridiculous. Come on, they had great earnings. This is ridiculous. This was the takeoff on after earnings, but I thought this is ridiculous. It's an apartment building. You're not moving out. Why they're being sold off, I don't know. In Canada, we don't have a big selection of apartment REITs, unfortunately. There's only 6 publicly traded ones. This is the best of them. Years back, Northview Apartment REIT was the best of the 7 that we had, but it was taken private. That if I had to bet one being taken private in the next little while, if one would be taken private in Canada, it would be this one, because it's just a strong company. July $30 calls 40 cents. The 65 puts for July, 65 puts. Sorry, the $46 put for July is 65 cents. That's where I would probably buy more, so I have no problem selling the July 46 put combined with the July $52 call. It's $1.05. We're sitting at 48.87. I like these target prices. The dividend yield on it is low. It's about 3%. So you really have to try to manufacture your own dividend. There's 140. Take 140 divided by 48.87. You don't get very far with it. So manufacturing your own dividend makes sense. If it's something that you want to own for its capital appreciation, I do think that these levels are in their future. I don't know when. I don't expect that this sell-off is going to be met with, sell-offs we've seen in the past have this kind of flavor to them. They just have these big recoveries. Equity markets drop and then they just completely recover. I don't think that's going to happen. I think you'll get something that looks more like this. So, 52 for July. I can see, sort of some technical level there, which is why I chose the 52 for July. But if you're looking in the real estate sector, I don't know that the suppliers and the home builders make a lot of sense, but the apartment REITs, I think, make significant sense. This is one that I particularly like. However, before I go, keep in mind, you do have a rate decision on June 1st. That if you were thinking of picking this up, I would at least wait till the rate decision, because you may get some softness in price as a result of this rate decision, because this is Canadian apartment REIT. It's going to respond to the Canadian interest rate environment, not the U.S. interest rate environment. So if there is a move of 50 basis points on June 1st, you may get some weakness in the price here, or being that this is so widely expected, it may already be in the price. Durable goods was reported last week. The link for this PDF is in the description box below. Some of you may find this interesting. April up 0.4%, March revised up 0.6%. It is a volatile series, so from month to month, it's hard to read the change and read any information in it month to month because it is so volatile. It breaks it down into a number of categories: new orders, shipments, unfilled orders, inventories, capital goods. And the tables are interesting to look at. I'm going fast through this because I don't know that there's a lot of interesting stuff that we can pull out of this, only because it is so volatile. But there is some consistencies we can look for. So it breaks it down. You have durable goods, you have total, excluding transportation, excluding defense. And then you have a bunch of other categories: primary metals, fabricated metals, machinery, computer and electronics. And you can, depending on what industry you're interested in or what you're looking at, you may get some information out of these. Let's look for our negative signs here. We have a negative 13.2. This is defense and aircraft parts, new orders. We have another negative sign down here, negative 6.1, defense capital goods, new orders. Well, this is consistent with what we saw in Q1 GDP for government spending. Government spending was down primarily because of defense spending. So this sort of matches that. Another table here is unfilled orders and total inventories. So you can see year over year what the percentage change in these are. And again, look for the negative signs. Negative 11.9, where'd that come from? Computer and related products, unfilled orders. Can't get the chips. So you had a lot of unfilled orders. Well, negative 11.9. What is that saying? Maybe you can, right? So maybe that is a hint at supply constraints loosening up a bit. Negative 6.7, unfilled orders for defense and aircraft parts. Where else do we have a negative sign? Negative 3.4, defense capital goods, unfilled order for capital goods. But that is consistent again with what we saw with government spending in Q1. So if you're interested in this report, it was out on May the 25th. I always find that if, rather than just looking at the numbers, when you go to the report itself, you get a lot more information, and you might find that, hey, you know what, I always wondered where this information was. This is more for you to, have an idea of where to find it and have a look at it. We also saw our second look at Q1 GDP. Q1 GDP was negative 1.4. It's been revised to negative 1.5. So let's look at our components. The consumer component, 2.09%. Goods, 0%. Breaks down into durable goods, up 0.57%. Non-durable goods, negative 0.57%. So they offset each other. Services, 2.09. Look at the difference, 2.090. This is the shift away from goods back to services, the shift that neither Target nor Walmart saw. Not only that, I think it was Abercrombie and Fitch, and there was another clothing retailer that reported massive increases in inventory and a lot of write-downs because they ordered way too much apparel. So it is not just Walmart and Target that misjudged. It was a lot of retailers that misjudged the trend, thinking that the strength they saw in the last few years in goods was going to remain. So 2.09, this is real, by the way. This is not nominal, this is real. And that means an increase in output, 2.09% from the consumer. As we keep going down, we have gross private domestic investment. This is the I. That's 0.1. Fixed investment is 1.18. Change in inventories took away 1.09. Net export of goods and services, look what happened there, 3.23. Exports dropped. The Canadian dollar was the US dollar was killer strong, so you would have expected some hit to exports, but it's the imports, negative 2.61. Took real GDP down by 2.61%. Which was what brought it negative. And then we have government consumption expenditures, negative 0.47. National defense, there it is right there, down 0.33 of that 0.47. So government spending negative, okay, good, nothing wrong with that. This I think we can ignore. I don't know that you're going to continue to see this kind of big negative number here. So I think we can, the imports negative 2.61. I think we, between Q4 of 2021 and Q1 of 2022, most of the retailers that reported in Q1 recognized that they have an inventory problem and have said that they've already adjusted their purchases for that. So I think that will decrease going forward. But the big story here, right, the consumer, 2.09, not just the consumer, but the shift back to services. All of the consumer growth in real GDP came from services. Goods were flat, with a trade-off between durable versus non-durable goods. The big report on Friday, what lifted the market all day long into the close, was the PCE report. It came in good. Personal income and outlays. Lots of tables to look at here. We're not going to worry about personal incomes. We're really going to just look at the price indexes. PCE, look where we were: December, January, February, March. Look at this, 0.2. April, lower than all of them. PCE excluding food and energy. It's basically, if you look here, 0.3, 0.3, 0.3. It's not increasing. It's gone sideways for the last 3 months. So let's, this is year over year change. If we look at PCE excluding food and energy, 4.9, you got to go back to December to get that. Here, 6.3, this is the total. So we know that food and energy are still elevated. If taking them out means we can go all the way back to December, and this is still elevated, there has to be something in food and energy. We'll see that it's food. Energy is really given way. So we have a listing here of all the indexes that we want. We're going to look at number 9, price indexes for personal consumption expenditure. This is change from preceding period. This is month over month, and then table 11 is year over year. So let's find table 9 and 11. Where are we here? 8. Table 9, bottom of the panel here, percent change for goods. We can see where it breaks down, right? Goods, negative 0.2. Non-durable goods up 0.1. Durable goods up 0.1. Non-durables negative 0.3. Durables are goods that usually defined as that have an average life of greater than 3 years. Non-durable goods are things that you can touch and pick up that are not durable in the sense that they last very long. Negative 0.3. Services 0.5. So it mostly came from services here, because goods negative 0.2. What I said about Walmart and Target and their inventory and the write-downs that they had to go through to clear out some of their inventory, I was saying that is deflationary. Negative signs are deflationary. Disinflation is if inflation is 5%, then 4, then 3, then 2, then 1. It's still positive, but it's decreasing. That's disinflation. Deflation actually has negative numbers in front of it. PCE, excluding food and energy, 0.3. And again, it's basically been sideways for 3 months. If we look at our series here, September, and it jumped to 0.5 in October, 0.5 November, December, January to 0.4, then 0.3, 0.3, 0.3. It's basically sideways here. Food is here. Energy and services, negative 2.8. After a big jump in March, it's starting to come down a bit. And then this market-based PCE. Sometimes in the PCE, you'll have imputed prices because observable prices don't exist for certain things. So they'll impute a price. And this is just, well, if we don't impute any prices, what do we have? 0.2, excluding food and energy, 0.3. Let's look at table 11. That's year over year. So here we are, 6.3. Goods, 9.5. That's going back to February to hit the 9.5 again. Look at the breakdown here. Durable goods, 8.4. Look how far back you have to go to get as low as 8.4. Past September, but not quite October. You know, you had 10.6, 11.5, 11, 10.2, 8.4 year over year. Down from 10.2, down from 11, down from 11.5. Non-durable goods, 10.1 is lower than the 10.8, but certainly not where we need it to be. Services 4.6. That's basically just been going sideways on this one. We don't see a lot of increases, but 4.3, 4.5, 4.6, 4.5, 4.6. Excluding food and energy, 4.9. Again, look back at that one. You had a 4.9 here in December. 5.1, 5.3, 5.2, 4.9. So 5.3 down to 5.2, 5.2 down to 4.9. It's coming down. Food is not. Look at that, from September 4.1. Now we're 10% year over year. Energy 30%. That's no surprise there. Well, we can all see that at the pumps, but it is abating from March, down 30. I don't expect that to hold. We'll look at energy in a little bit and discuss that. I don't see the higher prices in energy ending anytime soon. Market-based PC 6.5, and this is excluding food and energy, 4.9. And again, 5.1, 5.2, 4.9, all going in the right direction. Also last week, the Congressional Budget Office released its updated projections, Economic Outlook 2022 to 2032. When I see this 2032, I think, okay, I'm gonna ignore that. There's no possible way that you can project out 10 years other than just linearly. So I'm going to ignore that. But 2022, that'll be interesting to look at. So it's got some introduction, and then you have your table of contents. Link for this is in the description box. It's long. It's over 100 pages. We're just interested in the economic outlook. That starts at page 21. If you're interested for deficits and debts, that's the first 20 pages. The economic outlook is what we're looking for. You got spending, revenues. But let's go to page 21. I've highlighted just a few paragraphs that I think we should read. Here we are. The economic outlook. PCE increases by 4% in 2022. These are its projections. Inflation remains elevated. Its pace since mid-21 has been the fastest for 4 decades. CBO's projection, the price index for personal consumption expenditure, the PCE, increases by 4% in 2022. And we're at 4.9 right now. So they are expecting to see it drop to 4% by the end of the year. In the second half of 2022, supply-side conditions improve and energy prices decrease. I'm going to part ways with them on this one. I don't see energy prices decreasing. I do see supply-side conditions improving, but I don't see that. Inflation as a measure by the PCE price index falls to 2.3% in 2023. From 4 to 2.3%. From 2024 to 2026, this is fantasy now. Inflation remains near the Federal Reserve's long-run goal of 2%. I mean, come on. Hey, where do you think it's going to be in 5 years? I don't know. What's the target? 2%? Throw it there. What kind of analysis are you doing to get to that? And come on, the further out you project, the more fantasy it becomes. You're going to project out a quarter or 2 quarters. There's some semblance of reality there, but give me 10-year projections. Come on, I'm not going to read them. But 4% in 2022, that's what they see. Supply side conditions improving. They already are, so that's not much to say. Energy prices decreasing. I'm not seeing it. Real gross domestic product grows by 3.1% in 2022. The GDP now forecast from Atlanta Feds, I think, sitting just a little under 2%. And some of the major banks were in between the 2 to the 3%. 3.1 is, I think, one of the more aggressive ones that I've seen. 3.1, I think it's something lower than 3.1. But after 2022, several factors, including tightening monetary policy and waning fiscal support, combined to slow the growth of output. The annual growth of real GDP averages 1.6% from 2023 to 2026. So if they're thinking 2.3% in 2023 and then 2% after that, to get to nominal GDP, you're roughly 3.9% nominal in 2023, with about 3.5% 2024, 25, and 26. I think it'll be somewhat higher than that, just based on all that pent-up investment spending that corporations are holding back on. We're still going to look at the CEO survey and see how many are holding back on business investment. Let's see, interest rates. Interest rates on Treasury securities rise. To contain inflationary pressure, the Federal Reserve raises the target range for the federal funds rate That rate increases to 1.9% by the end of 2022, which is considered low. Really, that's considered low. And to 2.6 by the end of 2023. The federal funds futures has it at about 2.8. They're 2.6, but it has year end significantly higher than 1.9. We're at 75 to 100 basis points now, and we've got 100 basis points at the next two meetings, which would put us at 1.75 to 2. We would have to think that at that point they're going to slow right down and stop. That the data will be supportive of them stopping. I don't think so. I think they're light on that one. Treasury notes rise from 1.5% in the fourth quarter of 2021 to 3.1% in the fourth quarter of 2024. We're sitting, this is the 10-year sitting at 2.74 right now. Getting to 3.1? Yeah, I think so. But it just doesn't seem consistent with some of the other numbers that they have in here. So, it is widely read. It is a nonpartisan office that puts this out. It's okay to disagree with certain things. I agree on the supply side conditions improving. We're already seeing signs of that. I think inflation still continues to come down. I think we'll get to 2%, and not only 2%, I think we will overshoot that 2% and get much lower than that 2%. That by the time you get to 2024, 2025, into 2026, you're going to have a Japanese-style problem saying, we need inflation. What can we do? And they'll be printing and printing and printing of money to try to get inflation, because deflation, I think, it was the enemy. For a while, it was threatening to be the enemy, and I think it is going to come back. This is a blip that was induced by shutting down the entire economy and restarting it, thinking that we could just pick up where we left off. Once the efficiency comes back into the system, I think we will see that deflation will be our enemy. So I don't quite think that we're going to stop at this 2%. 3.1 I think is aggressive as well. I think somewhere in the mid 2s, 2.5. Although I think this 1.6 is not aggressive enough. So I think it is a little bit higher than that. Okay, let's have a look at a nice tight little formula here. Value of the equity market can be approximated by GDP multiplied by S being the share of earnings in GDP, multiplied by PE, a PE ratio. You think of it at the level of the company. GDP is really just revenue, share of profits in GDP. That's your net profit margin, and then you have your PE multiple. So when a company reports earnings, they'll report revenues, they'll report earnings, which is their net profit margin. You multiply that by a multiple, and you'll get a price for the stock. This is just the value of the equity market. We're not going to go through an exercise of valuing the equity markets, because it is all equity, not just publicly traded, but the value of all equity, because this is not just GDP from publicly traded companies, it's GDP from the country. This just gives us an idea of the direction that we can expect the equity markets to move in, depending on where we think GDP is going, where we think corporate margins are going, especially the net profit margin, and what multiple the market sees willing to place on this. If you have increasing GDP and you have increasing net profit margins, you'll get multiple expansion. So let's look at GDP first. We've seen a second look at first quarter GDP. The consumer was strong. Congressional Budget Office is looking at 3.1, but I've seen ranges anywhere from 1.8 for the year to 3.1. So, depending on what number you think works for you. C plus I plus G plus X minus M. For the consumer, lots of good news here. Wage gains, high employment, high propensity to consume. The bottom 70% almost have a 100% propensity to consume. You give them more money, they will go to the mall. They'll go to the mall all the time complaining that the economy is going to hell in a handbasket. Look at the price of food. Look at the price of gas. We're going to hell. I can't wait to get to the mall. Higher food and energy prices for longer, however. So this is sort of a headwind against the consumer as well. You have this going on, but they do have good wage gains, and we do have high unemployment. They are facing higher financing costs for any level of debt. So, every time you have a plus, you're going to have a list of minuses. Although I think overall the consumer is in good shape. Without a credit crisis on the horizon, consumer spending is not going to lead us into a recession. So the consumer, I think, is supportive of GDP growth. This is a bit of a problem here. I think you're going to have lower business investment because CEOs have this mindset of a recession expectation. They're looking at labor shortages, elevated input costs, and higher cost of capital ahead because the Fed is not done raising rates at this point. And we'll look at the CEO the CEO survey here shortly. As soon as we finish the screen, we'll see that a significant proportion of CEOs are saying, look, we're just delaying any capital investment at this point in time. So I think I is going to be under pressure. G and X minus M are hard to predict. They're hard to predict. So G, I don't know where G is going to go. And X minus M, if you have another wave of imports hitting because of all the orders that were placed based on some linear projection of what goods consumption would be, then it's going to continue to weigh on GDP, but I don't know where M is going to go or where X. Those are notoriously difficult to project. The C and the I become a lot easier because there's a lot more data points that you can use to look at the health of the consumer, look at the propensity and the willingness of businesses to invest. So C plus I think, are good. G and the trade balance, these are wild cards. For net profit margin, really it's revenue minus expenses. What we're seeing right now is less than perfect pass-through. PPI is higher than CPI, so the input costs that companies have aren't being fed through perfectly, but PPI is not 100% of the costs that companies face. It is a percentage of the costs that they face. So maybe they are passing through most of the costs that they're getting. Corporate profits as a share of GDP came in for Q1 of 2022 at 11.23%, down from 12, a little over 12. I think it was 12.1 in Q4 of 2021. 11.23%, still, as Adam Sandler would say, not too shabby. Historical average is 6%. That's going all the way back to late 1940s, early 1950s for the series. The historical average is 6% up to about the year 2000. Then after that, it jumps. And the recent average, last 20-year average, is about 10%. A lot of this is two reasons. Is you had a massive increase in productivity because of information technology that's suddenly started to pay off. You had IT showing up in the mid-80s to the mid-90s, late 90s, but measuring the return on your IT investment yielded no results because it wasn't really showing any return. But only in the last 20 years or so has that actually translated into higher productivity. The other thing here is world trade. China entered the World Trade Organization, I think 1999, 2000. So a lot of work was sent to China, low cost, right? Low cost, but prices did not drop for American consumers at all. It was just profit margins widened. So, I think we can look at that recent average of 10% and say that's probably a mean reverting level, maybe. 12.1 down to 11.2. Where's it going to go? When we look at earnings for Q1 and we'll look at the forward 4 quarters earnings, it was brought down. It was 235, is now down to 233. So the forward earnings estimate is coming down, and there are a lot of market participants that saying, look, a whole bunch of things have already happened except for earnings. They have not come down. That needs to come down. The multiple has come down, but earnings has not come down, and they're thinking that that's the next leg down on the market is It's not so much a decreasing multiple, but you have to decrease those forward earnings, and we have seen them come down. This is questionable. Can we increase margins from 11.2 back up to 12 on a going forward basis? If your answer to that is no, then you have an arrow down on the share of profits in GDP. If C plus I can be greater than G plus X minus M by a significant amount, that you have growth in GDP, great. If not, then you're kind of looking at the estimates and we have a downward revision here. Well, if you have both of these going down, you're going to get a lower multiple. If you have them mixed, maybe the multiple doesn't move very much. The best case is you're forecasting great GDP growth and margin expansion at the same time. Kind of hard to, you're looking at 11.237%. You've got less than perfect pass-through. You have bottlenecks, supply bottlenecks still. You have, elevated costs, elevated input costs. Most CEOs are reporting labor shortages and labor hard to find, along with increasing costs of labor going forward. Without a investment in productivity, usually you can keep your margins or even increase your margins if you have a significant investment in productivity enhancing capital equipment. But CEOs are saying no, we're holding off on that. This I think is questionable whether it can go higher. If I had to bet on the direction, I would say lower before higher. So I would be drawing an arrow down from S. GDP, I think, from the first quarter is going to show better numbers than negative, depending on what imports are. But I don't see 4% real GDP this year. But somewhere in the mid-twos perhaps. So I'm going to be neutral on GDP, slightly negative on margins, but the multiple is already contracted quite a bit. If on a going forward basis our expectations for GDP and for margins are increasing, you will get multiple expansion. So not only will you get higher earnings, you will also get multiple expansion. These two things together with increasing GDP, that is excellent for equity markets. This is even worse here. If your expectation for GDP and corporate margins are both decreasing, you will get multiple contraction. The worst one I heard is that earnings have to come down 10% from where they are. Earnings have to come down 10% and you have to apply a 14 forward multiple to that. So we'll draw that out on the SPY chart, and we'll see exactly what level we would get to if earnings were 10% lower than where they are. And they have come down already, but we went to a 14 multiple on that. So at the bottom of the screen here, desirable GDP growth with elevated capital investment to spur productivity gains. When you start seeing the CEO survey of CEOs saying, a higher and higher percentage of them are committing, are saying, no, in the next 12 months, we are increasing our capital investment. That is the time where you can start to say, well, that is going to spur productivity gains, which will drive GDP growth. Let's get in. Okay, this is released by the Conference Board, U.S. CEO Confidence, and there's a number of indexes that we can look at as well. CEO Confidence declined sharply in Q2. Confidence dropped to levels not seen since the start of COVID. So we can skip most of this. There we are here. Anything under 50, it's a diffusion index, right? Anything under 50 isn't very good. CEO's assessment of general economic conditions declined in Q2. 14% of CEOs reported economic conditions were better compared to 6 months ago, down from 34%. 61 said conditions were worse, up from 35. More pessimistic about conditions in their own industries. Future conditions, expectations about short-term economic outlook weakened. 19 said they expected economic conditions to improve over the next 6 months, down from 50%. That's a big drop. 60% expected conditions to worsen, up from 23. Huge. Let's see, employment, recruiting, wages, and capital spending. Capital spending is the big one here. 38% of CEOs expect to increase their capital budgets in the year ahead, down from 48%. 38 down from 48. That means 62 are not increasing their capital budgets. 91% of CEOs expect to increase wages by 3% or more over the next year, up from 85% in Q1. Well, unless you can pass that 3% through well, it won't be 3%. Wages don't make up 3% of cost of goods sold or cost of services. But unless you can pass that through, there go margins, right? Employment, 63% of CEOs expect to expand their workforce, down from 66%. I don't know that you could read too much into that. That kind of looks like it's about the same. 80% of CEOs report some problems attracting qualified workers, down from 83%. Notably, 61% report difficulties that cut across the organization rather than concentrated in a few key areas, down from 66%. Slightly down on both of them, but not enough to really say much here. Nearly 60% of CEOs expect inflation will come down over the next few years, but the U.S. will have a very short, mild recession, which the Fed offsets, while 11% foresee a challenging recession. 20% said inflation will stay elevated over the next few years and U.S. growth will slow significantly. These are CEOs. This is what they're thinking. So if they're thinking this, how many of them are going to say, let's build a new factory, let's expand our capacity, let's set up a new office in a new city? Most of them are going to pull in their capital spending, hiring freezes for companies that are facing tougher times. A lot of the tech companies have put hiring freezes in only because of the performance of their stock price over the last little while. And some companies have even started announcing layoffs. The most notable one was Netflix laying off. So it gets into a bunch of questions after that. What do you expect to be the most likely outcome for the U.S. economy? Tightening monetary policy. Inflation will come down over the next few years, but the U.S. will have a very short, mild recession, which the Fed offsets. A very mild recession, 57%. You don't invest going into a recession, you invest coming out of one, depending on your timelines. And there's a lot of other questions here if you're interested in reading this. The big one for me was the capital spending. 48% were going to increase their budget. Now it's down to 38% increase their capital budgets. That's going to affect I in GDP, and that's going to affect the level of productivity and the speed at which we get to those levels of productivity in the future, which are going to affect margins. Neither one of those two things, are tailwinds for margins. They're headwinds for margins and headwinds for GDP growth. All right, here is SPY, last 2 years. So this is a 2-year chart on the SPY. Forward earnings 233.49, down from 235.22 last week. So we are getting some downward pressure on the forward earnings forecast. At this number, we are now at 17.8 times forward earnings based on where we ended on Friday. And I used the 19 multiple to set what I think would be an upper limit to where the market can go at this point, 44.36. I don't think we get there. I don't think that we turn around, although who knows what can happen in the world we're in. All it takes is one event somewhere to cause a cascade in something. So, assuming nothing changes from the time that I post this video to the time we open Tuesday morning in the U.S., I don't expect there to be downward pressure. I think we still continue to get gains out of the market, because last week was extremely supportive. If Treasury yields are under pressure and we see even more negative real rates or going into the direction of heading to zero and negative, that's supportive for risky assets. So it'll depend on the narrative that exists next week, but I just can't see 44.36. I'm not willing to sell calls just yet, but we push up another 50 to 100 points on the index, I would be selling the SPY 443s. I just don't know that multiple makes a lot of sense, given that GDP seems to be neutral. to slightly negative in terms of its outlook, and corporate margins seem to be slightly negative to its outlook as well. I don't see getting back to a 19 times forward earnings. Here's 17, here's 16, and how we break down under 16. What are the risks here? If we start seeing significant downward revisions to earnings, because even if you have 17.81, if you're multiplying it by a lower and lower and lower and lower number, you're going to have a lower and lower and lower price. It doesn't necessarily mean that we get down to 16 times. I'm not suggesting that we would trade down on a multiple, but significant downward revisions to earnings would also reduce the multiple along with what you're multiplying it by. Also, significant downgrades to GDP growth. This really has a lot to do with where energy prices are going to go and where food prices are going to go. If they continue, food prices continue to remain high, and if energy prices, which had a breakout last week, if energy prices start pushing on to newer highs, and you go from $5 a gallon in the U.S. to $6 to $6.50, which, by the way, is a price that most other countries already have. If you look at the U.S. equivalent price per gallon in Canada, we are well above $6 a gallon here in Canada, considering the exchange rate. And the stronger the Canadian dollar gets, the more expensive it is on the U.S. basis. So, but for the U.S. market, that will begin to affect how consumers begin to behave. So significant downgrades to GDP growth, significant downward revisions to earnings, as we've seen on the previous screen. If you get two of these things going on at the same time, you will get downward compression on that multiple as well. This is the worst one I've heard, is 10%. Earnings have to come down 10%. So if 233 is our forward earnings multiplied by 0.9, that means it's down 10%, 90% of the number. And apply a multiple of 14. That was the forecast. 29.42 is the target. 29.42. That would take you back to July 20th. There's just after the pandemic. I don't know. I can't see it. This is just not supported by wages and employment. You have significant increases in wages year over year. You have more people working. You have a low unemployment rate, even though your participation rate is lower than it was pre-pandemic. Credit growth still exists. We're not having any kind of credit constraint or credit crisis. It still exists. And the consumer, the marginal propensity to spend, again, on that lower 70% is almost 100%. So I just can't see this scenario. However, if you do get significant downward revisions to earnings that bring it down from 233 to, let's say, 210, I think you could see a multiple go from 17.8 maybe down to 16, even down to 15. This is, I think, a very dire case, but here are your threats. These two right here. Okay, this is SPY for the last 2 weeks, and let's just revisit the trade I had suggested last week, which was to buy the call, buy an upside call, and then step into a bull spread either at 40.50 or 41.50, because those were 2 points of resistance. We can see the consolidation here around 40.50 for a period of time, and then we broke through 41.50 on Friday. If you had put on the call on the opening on Monday in the first 15 minutes, 9:30, 9:45, SPY hung out around 392. You could have bought that 400 call for June, and what a day, what a ride. Wasn't that beautiful? What I was doing, I prefer risk reversals, because when you have elevated skew, you can get really asymmetric strikes. So on this one here, I added some risk reversals, $10. I usually go $10 out of the money. So wherever the index is, I'll go $10 up. That's my call. Then I'll go down into the puts, and I'll see how far down I have to go to finance that call. You can go down 23 points on the put, $10 up on the call, down 23 on the put, because when you're getting your skew on market sell-offs, your skew does this. So if you're here and on this point here, you're going 10 up, but you can, because the implied volatility is so high on the skew, you can go way out of the money on the put to finance that particular call, because implied volatility will be lower than where we are at the money, but the put will have very high implied volatility. Same thing here. When it did this, these kind of started to pay off a little bit, and I held on to them, and then it took another dump down, and I thought, well, let me just add some more because I'm comfortable going 23 out on this, and I did, and I added more. And then we had this beautiful thing. At 40.50, I took up 50% of my position, and 41.50 on Friday, I thought, I still think there's more upside. I should keep them, but I took them off. Now, I'm probably going to hate myself this week when Tuesday and Wednesday deliver another 100 points to the upside. I'm probably going to hate myself for doing that, but I still have a lot of delta beta, dollar delta beta. I still have a lot of positive dollar delta beta as we're going up, because I'm not ready to start selling the calls and lowering that yet. So, okay, I won't be going for the ride on that, but I did well on these. I did very well on these too, and they hit these targets faster than I thought, which is really nice. The reason I like risk reversals is really simple, because I have three things working for me. My call deltas are going to increase in value because I'm buying the call. They're going to increase in value as the market is going up, so I'm getting nice delta on the call going up. Those calls are just growing in value. And the put delta is decreasing because I sold the put. Not only that, the implied volatility on the put is decreasing at the same time. Look what happened to implied volatility. Look at that drop off. Look at 2 weeks ago where these things were. And this was basically almost 2 weeks ago. A little less than 2 weeks ago. This was 2 weeks ago here. Look how volatility just dropped right off. So what you have going on is you have the skew coming down, which means the premiums on the puts are decreasing very rapidly. So you're making money on the drop in implied volatility, but the market is moving up, which means it's pushing the price of the call up, dropping the value of the put even more. So you have, those three things on those two legs working for you. So the boost you get out of these risk reversals are fantastic. They make money fast, and they did well at both these targets. I was happy with the 50%, thinking, okay, we'll sit around here for a while, maybe we'll retrace a bit, but PCE came in, it was great, and I said, wow. By the end of the day, it was, wow. It's good. It's a good gain. Let's just take it and listen. I know I'm going to end up hating myself for this, but there it is. It was a nice trade. I hope some of you got in on the calls on Monday morning as well. Okay, this week in petroleum, May 25th, when this was released, oil broke out. WTI broke out of its trading range and went on to put new highs. Post-invasion new highs. Same with so the USO and the UGA went on to make new highs as well. Let's look at our inventory situation. Here is oil stocks. This is the 5-year average. Look where we are. We've come, straight down on this one. If we look at gasoline in terms of inventory, look at this coming straight down below the 5-year average, and we're going into the busy driving season. So prices are elevated. You have inventory that's dropping. And the big problem in the U.S., well, it's twofold. Number one is they're not investing in new fields. They're not investing in new wells because every country in the world is telling them we're going to obsolete your product. We're going to ban internal combustion engines by 2030, 2035. They're all on that particular train. Here's the thing, though. It's not going to be done. Can't be done. Supply channel simply can't do it for EV. I'll have my video for that up in a couple of days. The conclusion is it's those deadlines will be moved back and moved back. We've seen what happened to the housing market when you have a period of underinvestment. And we're seeing what's going on in the oil market now because you had a big period of underinvestment after oil prices crashed. And because oil majors and almost all oil and exploration companies now, you can take out the word exploration, it's all extraction companies now, aren't really looking for new oil fields at this point in time. And they're not that eager to raise production, and you've had massive underinvestment for a period of time. You're going to get more massive underinvestment. And those EV targets are not going to be met. They're going to have to move them back and move them back, which means you're going to need oil longer. I am looking for significantly higher prices in oil as you go 2-3 years out. We're going to look back and say, remember when it was $110 a barrel? Remember when you could fill up for $5 a gallon as you're pumping your $9, $10 a gallon gas? I see a big issue going forward. The other issue with the U.S. is the life of a well. A shale well, it's got about a 5-year life. Whereas if you look at conventional oil fields in Saudi Arabia or Venezuela, oil fields that were discovered 60 years ago are still pumping oil. That is not the case for a shale well. So you're going to have a rollover in U.S. production of oil. You got Russian oil that's potentially going to be off the market, a rollover in U.S. oil over the next few years. I don't know. It looks to me like it's setting up for nothing but upside. So for the Congressional Budget Office to suggest that energy prices are going to come down is, I think, to ignore the investment or the lack of investment that's going on across the entire energy space right now. So let's revisit our USO and UGA bull spreads that we had. Here's our breakout. This happened May 26th on the oil inventory report, and inventories still shrinking going into the busy season. Now, some of it may have to do with the fact that we're just ahead, that when this came out, we were facing the long weekend, the Memorial Day weekend, which is a big driving weekend. And maybe demand was, it's going to be off the charts. There's not enough supply. There's going to be a squeeze in the spot markets. And this might just be reflecting exuberance for that long weekend. And maybe after the weekend, it comes back down. But you had a breakout over a fairly long consolidation pattern. And the breakout didn't come back down. It attempted to, but found support and continued to go up. This is 85.10 on USO. So the 82.85 bull spread, when I had mentioned it, you could have picked it up for $1.30. Now has $1.60 of value, so it's up 23%. And the 82.90 bull spread for USO had a cost of $2.85. It's got a value of $3.68 now. It's up 29% just on that spread. And since it's a spread, it's a defined risk trade, which means you don't need any other margin than what you paid. So 130 and 285 would have been it. So we'll talk about the Canadian here in a second. UGA, which is for gas, I had introduced the 70-75 and the 70-80 spread. 170 for the 70 to 75 is now 235, up 38%, and 280 for the $10 spread, the 70 to 80. Ended Friday at a value of 395, up 41%. And I had introduced UGA as saying, it's not just the oil supply, not just the inventories on crude oil, but it's the refining capacity that has a bit of a problem as well. So gas will really, for every dollar that, or every 1% oil goes up, gas goes up by more than 1%. So UGA seemed to be a more profitable thing to play. Option spreads tighter. When I say spreads, between the bid and the ask, the spread is tighter on USO, wider on UGA. It doesn't mean that you can't get it. It's just wider, less liquid than they are on that. But you can always go and play RBOB if you want to play the futures, and you can play options on the futures. But this is a big contract, right? 42,000 gallons. If you're playing oil, it's 1,000 barrels, and the margins are elevated on those, which is why the ETFs sort of a nice place to play. So a bit of a warning here, price increase ahead of a long weekend, so it may face a pullback. UGA and USO may face a pullback. But I think if I were going to play something for the next 2 years, a buy and forget it for the next 2 years, I can't see a scenario other than massive destruction of demand. I can't see a scenario in which gas prices go down because you are facing supply constraints in EV. That for every car company to hit its target by 2025, all the investment that's announced, for every car company to hit its target in 2025, the supply doesn't exist today. And that's only 3 years out. The supply simply doesn't exist. GM says, oh, we'll have 2 million cars. Stellantis says we'll have this. Toyota says we'll have this. And if you add all that up and figure out how much raw material you need, it doesn't exist today. It exists in the earth, but it doesn't exist in the supply channel. It can't be done. Can't be done. A couple of them are going to have to lose for some to win, or everyone's just going to have to suffer with lower growth, which means we're going to need oil for longer than what we think, significantly longer than what we think. If you're wondering what those little pops are behind me, it's my trading system. Sunday night Globex, things are coming online, so something comes online, it gives me a little pop to let me know, hey, we're here. They pop their head up and the prices start flashing, and here we are. So there we are on USO and UGA. Let's talk about the Canadian dollar. It finally moved. Thank you. July, I had mentioned the July contract using futures 77.70. Let me just shut this guy down here so we don't hear those pops. 77.70. Finished the week at 78.53, up 83. So that's $830 per contract. Each contract required, I think, $2,900 in margin, which is not a bad return on the Canadian. I still think, much like David Rosenberg thinks, that it's still undervalued at this point. It had strength, and I think it'll have strength this week because the Bank of Canada is meeting on Wednesday, and they are fully expected to increase interest rates 50 basis points. And if they do that, the Canadian will get some support out of that. And I think on the announcement, I would probably lighten up maybe 5%, 10% of my position on the announcement because the Canadian is still going to be the tail on the US dollar dog. And if the US decides to gain strength into the end of the week or throughout next week, well, the Canadian isn't going to go it alone. It's not big enough to support a lot of money flows. One of the things I said before is I can't figure out the weakness in the Canadian dollar. And part of it got solved for me as I was reflecting on the investment in energy companies are making in new fields. And it occurred to me that this could be a problem with Canada. The last time oil was over $100 was the 2004, 2007 period. Somewhere in there, the Canadian dollar actually was worth more than the US dollar. But at the same time, you had billions of dollars coming into the country, going into the oil sands. Billions of dollars of investment. Every week something was announced. So you had all of this foreign direct investment at the same time that one of our exports was growing, not only in volumes, but also growing in dollar amounts. So these two things in combination had a lot of exuberance around the Canadian dollar. Well, now we have prices over $100, so you are getting, your volumes that you're exporting at higher prices, but you're not getting the foreign direct investment this time around. You're not getting any of that. So that could explain, why the Canadian dollar is languishing when oil seems to be increasing in price. It's a major export that we have. Our current our trade balance is positive. We should be bringing new money into the country, which is supportive of the Canadian dollar, and we're not really moving. FDI was driving the dollar last time. It's non-existent this time. So when David Rosenberg says, well, I think 83 cents, which is $1.20, is a target, I sort of have that in mind as well. I don't in any imagination think we're going to see par again. And a big reason is that foreign direct investment. Okay, let's look at the week ahead. There's really only one big risk factor this week coming up. That's the jobs report. But let's look at the economic calendar so we're aware of what the risks are. And then we'll take a break. So the calendar up here is for Canada and the U.S. May 31st. U.S. is closed. Canada was closed last Monday for our holiday. GDP growth annualized and quarter over quarter at 8:30 on Monday. That may be supportive of the dollar. It may tear it down. Who knows? What else have we got? Consumer confidence. They rate it as high, but I don't see that consumer confidence has much of a relationship with consumer behavior. Investor confidence does have a relationship with investor behavior. CEO confidence does have a relationship with CEO behavior and corporate behavior, but not the consumer. Mortgage applications again. You have manufacturing PMI in Canada and manufacturing PMI in the US. That could be interesting. There's the big one for Canada. You have your Bank of Canada interest rate decision. It's fully expected, 50 basis points. What is unknown is what's the market reaction going to be to that in terms of REITs and in terms of the Canadian dollar. Any sell-off in REITs on that day on Canadian REITs, especially Canadian apartment REIT, I'm a buyer. And the Canadian dollar, well, if it rallies on that, great. If it pulls back, oh well. I'll keep holding my Canadian dollar position, and we'll see what happens. ISM manufacturing for the U.S. So you have both the manufacturing PMI, the S&P Global, and the ISM. I think the ISM is the more relevant one. Let's keep going. Some Fed speak going on here. ADP. I don't know that anybody pays attention to ADP anymore. Building permits, nice leading indicator here. I don't think that anything that happens on these reports is going to move very much. This is the one that we're looking for down here. Non-farm payrolls for the U.S. Average hourly earnings are going to be looked at, and the participation rate. If that participation rate creeps up, that is nice. That is bullish. That's good for margins, because if you get a participation rate creeping up, you get less wage inflation pressure. That is good for margins. So let's see what happens on Friday. That's the big theme. You got a shortened week, Tuesday to Friday. Bank of Canada on Wednesday morning. Non-farm payrolls on Friday, with a few little data points spread here and there, but I don't think they're market moving. I think this is the big one. I don't see a lot of pressure on equity prices going into the week, so I think that we can continue to be supportive. But if this comes in bad, then it could change the tone of the marketplace. That here comes recession again, the talk of recession. But if this comes in, let's hope not strong, but if it comes in good. That's pretty good. You had good wage gains and you had an increase in the participation rate. I think that's the soft spot right there. You want to see a small weakening of the job market, but not so much that you say, oh my God, we're heading to a recession, but enough that you say, well, that's good for corporate margins. That's a narrow space to land in. But this is the excitement of this game that we play. ISM non-manufacturing PMI is on Friday as well. Anything over 50, because it's a diffusion index for both the manufacturing and non-man. Anything over 50 is growth. You just don't want to see it have less and less growth. And it's the sub-indices that you want to look at as well. So we'll look at those next week. And if you are into the energy space at all in the U.S., the rig count, you might want to watch the rig count. This will give you some indication of future supply if you see the rig count increasing significantly. Other than that, that is it for this week.